Hello, welcome back. Um, Today's topic is tips, and actually, it's the topic for this segment of the video. Tips stands for Treasury Inflation Protected Securities. It's also called indexed bond because the whole purpose of tips is to protect against inflation, to protect the value of the treasury bond or treasury note for inflation, right? So the bond is automatically indexed to the inflation, indexed to inflation. And other than treasury bond or treasury notes, I don't know of any corporate bond that is indexed to inflation. Now, the main reason for that would be that, first of all, you would wonder if TIPS is only for treasury bond or treasury notes, there's no TIPS for treasury bill? No, there's none. Why? First of all, it has to do with the nature of the maturity, right? The length of the maturity. First of all, if it is, you understand, treasury bill is a short-term bond with maturity up to 1 year. I mean, actually, it's less than 1 year, right? Because from maturity equal to 1 and above 1 year, equal to or greater than 1 year, already falls into treasury note. But although the technical definition is that from 1 year bond, 1 year maturity, it would be a treasury note. But then anything, think about it, no bond, no treasury bill is born with, exactly 11 months and 30 days, right? In other words, basically, the line, whether it is exactly equal to or greater than exact, or whether the treasury bill has to be something really, really less than 1 year, right? That line is kind of blurry. Why? Because some bonds, some treasury bills are born as treasury bills, right? Like 13 weeks. 13 weeks is like 3 months actually, right? 6 months. Or 9 months. I mean, they already have, a maturity less than 1 year. And if they issue a treasury bill with 1 year maturity, and they can do that, then it is born as treasury bill because, what's the point of calling it treasury note when its maturity is just exactly 1 year? But what I'm saying is not all the treasury bills are born as treasury bills. I mean, there are no treasury, there are, and also treasury notes, by definition, it has maturity between 1 and 10 years. But we've talked about this in, Finance 100, so it's just redundant to go over this, but I told you in Finance 100, 30-year bond, 30-year treasury bond although it was, when it was born as treasury bond when it was issued, right? And it was issued probably with 20 years to maturity or 30 years to maturity. But let's say 10 years have passed, okay, for a treasury bond with maturity of 20 years, 20-year maturity. Let's say 10 years have passed. How much, how many years, are left to maturity? Then 10 years left. Once that is under the maturity left falls under 10 years, then it is called a treasury note, right? It's not that they are born with um, the name treasury bond or treasury note, uh, uh, you know, uh, uh, etched on it. So, for example, even the treasury bond with 20 years, 30 years maturity uh, can turn into treasury note once the time has elapsed and their time left maturity falls below 10 years. And even the treasury note or treasury bond, when their time left maturity falls below 1 year, then they are traded as treasury bill. Okay? I mean, treasury note would say treasury note on it. Treasury bond will say treasury bond on it. But as time goes on, um, if the time left falls under certain threshold, then they are traded as uh, the next category. I mean, lower category. Okay, all righty. But then think about it. Because of the reason the tips only exist for treasury notes and bonds is because of that maturity. Because on the 1 year, the effect of inflation is not really uh, uh, there's hardly any effect of inflation, right? Because inflation is basically a annualized concept, annualized increase in price level. Inflation is measured, of course, it can be measured monthly, but uh, it's only if there has been appreciation in price level, it is more salient and more perceptible on an annual basis. Now, and the inflation is measured by CPI. Inflation is measured by CPI. Okay, so I'm not going to go over the examples we did in Finance 100, but basically, since we measure inflation by CPI, and once we have measured inflation, then all we need to do is make adjustment to the par value for that inflation factor. And as the par value is inflated, adjusted for inflation factor, then automatically coupon rate is also, coupon payment is also adjusted for that inflation. Coupon rate doesn't change, but think about it. Let me give you an example. So at time zero, par value when it was issued, par value is 1,000. 1 year later, let's say inflation has been there has been 2% inflation, right? 1 year between time zero and time one, the par value is adjusted for that inflation, so it's going to become $1,020. And then if the coupon was 8%, that means annually $80, semi-annually $40. Okay, and the coupon payment is adjusted for that factor, right? So so 1020 times 8% will be, then of course, will be $96, right? Okay, simply. I mean, not $96, but $91 and I mean $81.60. Whatever. Yeah, $81.60. So half of that, right? And of course, if it is a 3-year note, right, 3-year Treasury note, of course you don't get any, you don't get the redemption value until year 3, until the end of year 3, but you get, you collect coupons, and then between year 1 and year 2, I mean, year 1 this is year 1 actually, right? Between time 0 and time 1, between time 1 and time 2, that's year 2, right? So if the inflation has been 3%, right? In year 2, then we make adjustment. 3% means 3% over this value, right? So that means then make adjustment for year 2. So that 3%. So 1,000 times 1.03 will give you $1,050.60, and multiplying that by 8% will give you $84 and 4.8 cents. And of course, then divided by 2, and then, yes, divided by, and you will get, $42.02. And again, if there is in year 3, 1% inflation, right? So then all you need to do is, once again, adjust that $1,050.60 by 1.01, right? Okay, and then you get adjusted par value of 1,061.11, and then again 8% of that divided by 2, and finally at the end, so that's the semi-annual coupon payment, but you get 2 of them, and then finally you get that's the par value, right? So TIPS is not that difficult to understand, right? We can easily now, but basically, what nominal return they are talking about here is actually the now you can relate this to the concept of uh, cash flow plus capital gains, right? Well, it's actually, in this, and then price at time zero. Actually, the initial price. But this one is a little misspecified because price appreciation means capital gains. But if you have capital gains here, it cannot be okay. I'm not okay. Uh, uh, I'm not saying this is wrong. I'm just saying to make distinction between gross return and net return. I mean, what I'm saying was this is net return, not gross return. Okay, what I wanted to say was, this is nominal return, but it is net return. Now, to find real return, right? You have to make adjustment for inflation, right? Of course, what does 1 plus nominal return mean? Then that's gross return, right? Because it is gross return, you'll have to also adjust it by gross inflation, right? Again, then this ratio will come out as a gross ratio. It will be coming out as 1 point something. So that's why you'll have to subtract 1 from it to turn it into a net real return. Okay. Now, probably you might wonder why is this brought up at this point. It's because we normally think that the nominal I will just nominal return is real return plus inflation. Okay, and this is normally called the Fischer equation, right? Fischer equation. But it's not true. This is not exact Fischer equation. It's not. It's not. It's not exact Fischer equation. This is an approximation. Okay, this is only an approximation. The exact specification of Fischer equation is. This is actually, exact specification of Fischer equation. In other words, suppose you're solving for inflation. What would you do? Or suppose you are solving for, this specification tells you what? if you are just dealing with, uh, gross terms, right? I wonder if I can write. Okay, let me write it here. So what you should get, 1 plus, and let me use I for nominal interest rate. Okay, you all understand that. And then 1 plus pi. Pi stands for inflation in macroeconomics context. And then what should this be? This will be 1 plus real interest rate or real return, right? 1 plus I is nominal interest rate. And think about it. If you're adjusting, you put $10,000 in the bank, in the savings account, and let's say inflation, interest rate is 10%. 1 year later, you will have $11,000 in your bank account as future value 1. But that is nominal interest rate, right? And that's the nominal value of your money because, unless the inflation has been 0%, right? But if the inflation has been 5%, what is your real return? What is your real interest rate? You might think, oh, because in nominal interest rate is 10% and inflation is 5%. My real return, my real interest rate is 5%. You can simply, you can easily do that, but and you can subtract inflation from nominal interest rate because they are all percentages. They are all, but it is only an approximation. The exact specification would have to be like this, because think about it. If you have 10,000, if you put 10,000 K, 1 year later, what's it gonna be? 10,000 K, 10K times 1.1, right? And that will be 11K. And then if you want to make adjustment for inflation, then you should adjust it by you should divide it by 1.05. In other words, discount it by 1.05, which is the inflation, right? Gross inflation rate, gross inflation rate, and then you would get the exact gross real return. And from gross real return, you will have to subtract 1 to get to net real return. Okay, so that's this Fischer equation is, basically the basis of, how we make adjustment for inflation. So now we move on. I spent too much time on tips. I thought it won't take that much time, but somehow. Next is, bond rating, right? We all know basically a bond rating. There are 3 bond rating agencies, world-renowned 3 bond rating agencies: Standard & Poor, first, Moody's, and third one is IBC Fitch. IBC and Fitch. Fitch IBC, they call it just Fitch IBC as well. And you may understand that because we already talked about this also in Finance 100, I've been telling you, Standard and Poor's and Moody's are U.S. agencies, right? Rating agencies. IBC Fitch is British. Okay. Now, of course, AAA, AA are very high quality. So their, coupon rate doesn't have to be high. Of course, discount rate won't be, that high because you trust them. You don't have to discount it. I mean, if you have AAA bonds, which may not be as safe as Treasury because Treasury is risk free, but still they are very safe. So if if you have a AAA bond maturing in 1 year or 2 years, discounting hardly you don't need to discount that much. I mean, this discounting is only for the length of time to maturity. I mean, other than that, other factors, other risks. What did I say are the risks involved in a bond? First of all, default risk. Default risk is the greatest risk because in lending situation, right, there's nothing more disturbing than the default risk of the borrower, right? Second one is liquidity risk. Third one is I've been telling you, it's called, by different other names. Maturity risk, interest rate risk, price risk, right? They are all. And there's also reinvestment rate risk, but the reinvestment rate is close related with interest rate risk. So if you know that there is interest rate risk, then that automatically assumes that you know something about reinvestment rate risk as well. And then what was the and what's the fourth one? If you remember. So anyway, the fourth one is, of course, inflation risk, right? But as I said, inflation risk is across the economy. I mean, it's not specific to an individual borrower. It's not specific to. I mean, it affects every company across the economy, across the board, and in that matter, for that matter, right? For that matter, interest rate risk as well, right? So default risk and liquidity risk are um, uh, company specific, whereas interest rate risk and um, inflation risk are across the board, right? Now, so the rating system is pretty much the same. Um, I don't have the example of IBC Fitch, but they are not that much different. Um, of course, if Standard and Poor's call it AAA, what do you think this would be called? That's also AAA, and this is also AA, isn't it right? Um, I also, and this is Standard and Poor's has triple B, and what do you think this should be called? BAA? Yeah, it's BAA, but that's practically a triple B, right? And you understand that only I will draw the line here. Triple B and above are investment grade, and below triple B are very speculative, meaning highly risky or junk. Okay, junk bond. Okay, the name junk bond has a very derogatory connotation, but it actually means high return, high yield, high risk, right? Now, so we need to understand then what determines the bonds. What are the factors? What are the main factors that determine the bond ratings, right? Risk class, and we're running out of time, so we'll have to talk about that in the next video. But basically, look at these ratio categories. I mean, it's all ratios, fundamental analysis. In other words, ratios are the foundation of fundamental analysis. So basically, then what categories of ratios? That's what categories are most relevant. That's what we are gonna talk about in the next video. Okay, all righty. I'll see you guys in the next video, and stop recording.